Alright, hope everyone's doing well. Sorry for the loud noise. So, this video is going to be pretty simple. I'm going to just discuss two markets on the monthly, weekly, and daily charts, and really just kind of discuss what I think is going on in those markets. So, first, we'll look at the dollar, Japanese yen, and both of these are forex markets. As you can see, just kind of draw a few things. We're fairly close to resistance on the monthly chart. We broke above it here around 2015. It's around July of 2015. Strong rally, but again, tight enough channel. First reversal up should fail, and that basically means we are going to get a second leg down most likely. Now, I don't know if we're going to go all the way down to there. So really, big up, big down, big up. This kind of looks like a triangle. In a triangle, what that means is there's a swing up and a swing down. So there's a reason to buy and a reason to sell, which means the market's in a trading range. So I don't really have a lot to say with that. I think you had bulls buying up here, scaling in lower. They're disappointed, and they're going to look to exit. A lot of them were exiting somewhere in the middle. This is also a 50% pullback. 50% simply means you have bulls who are buying down here because they can risk basically one-to-one. They buy, put their stop down here, betting price gets up to here. They have to be at least 60% certain that they'll be right. A lot of those traders will simply buy and they'll put a stop somewhere down here and scalp out because they know there's disappointed bulls up here. There's disappointed bulls who bought, as you can see, this close, scalping out. And that's really it. Weekly chart, tight channel, trend line break. I said, if you can find my typed versions of my kind of weekend or monthly, weekly, and daily chart analysis of the euro, of the dollar, Japanese yen. You can find it on LinkedIn. And in the past, I was saying over here that the bulls need this bar to close on its high. It did not. Excuse me, it did not. Therefore, we'd probably test lower. Tight enough channel, first reversal will probably fail. This is a lower high as well as this. This is a major lower high. So technically still in a bear channel, but probably developed into a trading range by now. And as you can see, we're starting to go sideways. Daily chart. Not a whole lot to say about the daily chart. So tight channel up. Bulls bought the pullback. Roughly 50%. And very often when traders buy 50%, a lot of traders will scalp out. So they'll buy, scale in 10, 20, 30 pips lower. This is of course, this is a daily chart, so they're scaling in, 40 or 50 pips lower. So they'll buy somewhere in here, scale in lower, scalp out. Bears selling down here, scaling in, scalping out. So that's really, I don't have a lot to say with the dollar, Japanese yen. I think more sideways is most likely. And eventually we'll get a bear breakout, measure move down, which will take us below the low of here, or bull breakout, measure move up, takes us up here. Euro dollar monthly chart, trying to form a bottom, 3 pushes down. You call it a tight trading range, final flag. We have a logical, this is always interesting. We had a tight trading range, bear breakout below. The bulls who bought anywhere, the bulls who bought this low or this low or this low, if they're patient, they could avoid a loss. Now, I don't know. It works in theory, and it works on smaller. It would work here, but I don't know. I mean, I don't know if an institution or I don't know if they'd really want to hold, if they'd want to buy this low and wait until here to buy more and scalp out. I just don't think that's all that practical. However, whether or not it's actually being done, it's a logical approach. And anything that's logical, remember, 90% of the time, you can avoid a loss by doing something reasonable. You know, again, trading is, it's mostly, it's rational behavior. Any of y'all that pay attention to Al Brooks, y'all know that. So it's real simple. Bulls buying here, buying more somewhere down here, betting that price will test back to here. Think about a market. A market is in search of value. So the market saw this as value. We broke below, it sees this as value. It's eventually going to wonder and want to probably test back into here. Now, in terms of this, strong breakout, it'd be best if the bulls get another strong bull bar. Then maybe we get a measure move up. Daily chart, tight trading range, gap up, bad follow through, probably exhaustion, which makes me think that we will most likely, two things. I think we'll get above this high. I also think we'll get below this low. So I think this is exhaustion, and I legitimately think that traders selling here, using a stop up here, will probably make money betting that this gap closes. Think about it. Let me go to a daily chart and make this a little easier. So the traders who have, I'll go to a weekly chart. Strong rally, well, somewhat, but we've been rallying ever since the start of this year. And when you look at it, let me catch my breath real quick. When you look at it, best looking bull bar, bad follow through, you have to wonder if this is actually the start of a breakout or the end. I think this is exhaustion because strong bulls are not buying here. Weak bulls bought here. And if you think about it, if you're a bull, you're probably waiting for weak bears to exit. What I mean by that is you have bears who've been selling, and they're never going to give up. And then they see this big bar. Strong bears know that that is simply the bears who cannot take the pain of staying short any longer. So they buy back their shorts. You have weak bulls who buy back their, they go long, which leaves only two traders left. Now, so let me back up real quick and explain that let me explain that in a more simple concept. And in order for me to do that, let's go to the left. And let's look at these bars right here. Arguably, this is the best looking pair of bear bars ever since this entire move down. Now, to me, what that signifies, let's say you sold here, right here. You're holding short, and then you get the best looking bear bars of the move. Are you going to say, wow, this is an even stronger move? Or are you going to say, gee, that's a gift. I'm going to get out and take I'm going to take a profit. It's a gift. And traders are most likely strong bears. They sold here. They sold all through this right here. They're not going to sell down here. They're going to take the profit. And if they're taking the profit, they're not looking to sell, 3 or 4 or 5 bars later. They're waiting for at least 10 bars and at least 2 legs because they would not buy back their shorts if they did not think there would be a decent pullback. So what does this mean? This means that strong bears are out. The bears who sold during here, they have bought back their shorts and they are not selling. You have strong bulls who have been buying here, here, and here. They will never buy back. They will never sell out of their longs. So nothing is going to scare them out because they will see every piece that goes lower as a discount. That leaves you with weak bears, weak bulls. Now the weak bears, they've been waiting. They say, finally, we're going to go lower. I'm going to sell. And they'll probably put their stop up here. You have the weak bulls who, they started buying here, here, and here. Finally, they see this and they cannot take the pain. They say, I know this is probably the bottom, but I can't take the chance. If I lose here, I'll get killed. If I'm wrong and price breaks out lower, I'll get ruined. So they buy back their shorts. They sell out of their longs. So let's review that. You have the strong bears who sold up here, they're out. Strong bulls who will buy every imaginable piece lower, and they know they won't lose. That leaves you with weak bears and weak bulls. You have the weak bulls who cannot take the pain of another collapse, so they're out of the market. They're buying back. They're selling out of their longs at the worst possible price. You have the weak bears who are selling here because they think the trend's finally starting when it's probably the end of it. That means, the only traders down here are buying. So when we look at that, and both sides, and the strong bulls, strong bears, they know what each other are doing. Now, don't take don't take it too literal. When I say strong bears, and this is all Al Brooks terminology, but when I say strong bears, I don't mean that the strong bears are smart and the weak bears are stupid. I just simply mean that it's just a simple way for me to explain it. It's a way. I try not to make it too. It makes sense to me. That's all that matters. I don't try and make it too complicated. Because both the bulls and the bears know that traders are exiting. What are they going to do? They're going to buy down here. Many will buy above a bull bar, certainly a second entry, and use a wide stop. Others will buy down here, use a wide stop, betting the price gets back up to here. And that is the exact same thing that's happening here. You have bears selling, wide stop, betting price gets down to here. The bulls, well, what do they know? They know the bears are going to do that. So bulls get out. They're looking to buy down here, betting the price will resume. Even over here, let's say you sold and put your stop up here. You could sell more here, still make a profit. You can actually see you would have gotten out at your original entry. So again, 90% of the time you make money. So let me go back to kind of what I was talking more about. Big trading range, multiple legs up, probably exhaustion, probably will close the gap down here. So if anything, I think I'd be selling, stop up here, betting the price gets down to here, and I'd be willing to scale in.